The indenture also identifies which of the firm's assets, if any, are pledged as collateral for the bonds. PPG Industries, a leading manufacturer of fiberglass industrial chemicals and medical supplies, has a $150 million debt issue that matures on May 1, 2021. Until the maturity date, the bondholders, including those who purchased the initial offering in 1991, will be paid 9.12% interest each year. In addition, they will receive a total of 150 million, the principal amount owed by PPG. When the bonds mature and are retired, the bond indenture contains no specific pledge of particular assets for the security. Equity financing. Although debt financing often has strong appeal, looking inside the company for long term funding is sometimes preferable. In small companies, for example, uh, founders may increase personal investment in their own firms. In most cases, equity financing means issuing common stock or retaining the firm's earning. Both options involve putting the owner's capital to work. Common stock. People who purchase common stock seek profits in two forms: dividends and appreciation. Overall, shareholders hope for an increase in the market value of their stock appreciation because the firm has profited and grown. By issuing shares of stock, the company gets the funds it needs for buying land, building, and equipment. Supposedly, Sunshine Earnings and the Sunshine's Tannings founders invested $10,000 by buying the original 500 shares of the common stock at $20 per share in 1996. The company used the funds to buy equipment and it succeeded financially. By 2004, then it needed funds for expansion. A pattern of the profitable operations and regularity paid dividends now allows Sunshine to raise $50,000 by selling 500 new shares of the stock at $100 per share. This $50,000 would constitute paid in capital, uh, additional money above the par value of its original stock sales, paid directly to the firm by its owner. We have already described it in the previous chapter, and it will show the additional paid up capital that would increase the total stockholders' equity $60,000. Finally, we should note that the use of equity financing by means of common stock can be expensive because paying dividend is more expensive than paying bond interest. Why? Because the interest paid to bondholders is a business expense, therefore a tax deduction for the firm. Stock dividends are not the tax deductible, they are the profits, in fact. Retained earnings. As presented earlier, the retained earnings are profits retained for the firm's use rather than paid out in the dividends. If company uses retained earnings as capital, it will not have to borrow money or pay interest. If firm has a history of reaping profits for reinvesting retained earnings, it may be very attractive to some investors. Retained earnings, however, means smaller dividend for shareholders. In this sense, then the practice may decrease the demand for and thus the price of the company's stock. For example, if Sunshine Tanning had net earning of $50,000 in 2004, it should pay $50 per share dividend on its 100,000 shares of common stock. Let's say, however, the Sunshine plans to model or remodel at a cost of $30,000, intending to retain $30,000 in earning finance the project. Only $20,000 and $20 per share will be available for the shareholders. Financial burden on the firm. As we have already explained that the firm cannot deduct paid out dividend as business expenses, but it can deduct the interest that it pays on bonds. If equity funding can be so expensive, Why do the firms not rely entirely on debt financing? Loans and bonds carry fixed interest and represent fixed promises to pay regardless of changes in the economic conditions.